Hey everyone, Eric here with the long-awaited example for the covered strangle strategy. So I've had a handful of people reach out saying, basically, where the hell is this thing? Which is super fair. I really didn't take the time to sit down and knock it out because I had to parse through a ton of trades. During this time in the market, I was essentially trading my IRA accounts as well as my margin slash traditional brokerage account. So it was really, really hectic. So it took a little while to sit down and actually tie the trades to specific pieces, but I did that today. So here is the game plan. I'll do a very quick overview. So let me get my face out the way. This is essentially the duration of this trade that I'm going to be honing in on. It started on the 9th of March, and then I essentially exited technically after the market on the 22nd, which is a Friday of expiration. So the 23rd is when everything would have settled. So this is the duration of the trade we're going to be going through. And each one of these highlighted bubbles just signifies a trade that, or a day that a trade was made. So as you can see, I started offering the market on the 9th of March. This is right when the COVID drop started. And I had a bunch of other trades going on at this time. In this example, this was all cash secured in the margin account. And I did have to break apart some trades. So what I mean by that is at one point in this, you'll see I was assigned. And I was also using that stock for some other pieces of other trades, but I did my best to isolate things just so that we could have a clean example of this that wasn't too convoluted. I hope that this follows that. There's a little bit of movement. It's not awful, but if I were to kind of walk through everything that was going on in totality, I think it would be pretty brutal for anybody to really keep line on. So trying to keep it simple for the example. Okay, so let's take a look at this first trade. On the 9th of March in 2020, I sold to open 5 of the 20 March 127 puts, made $3.28. What you'll notice is there's just going to be a little counter on the side here. This is just keeping track of unrealized and realized P&L. So the idea here is just so that you can see when money's coming in, when money's going out, and keep a track as we go, just because there will be some rolls and some covered calls, so it gets a little tricky, but not too bad. So pretty much that was it this day. So moving on, you'll see on the 11th of March, I ended up taking in those 127 puts, paying $4.56. So that's that 22.80 you see there. And then I rolled them out to the 27 March 125 puts, collecting $5.02. So that takes us to currently P&L of 1870. The reason for this roll at the time is just pure uncertainty in the market. In a lot of different market conditions, that $2 roll adding a week works really well. Didn't work well here. We just experienced a follow-on drop that it's really tough to prepare for, and you'll kind of see how I handled that. But in this instance, start of the trade, we started at a high of 136 and we took it to a low of 95.69. So it's a pretty big move, especially in a product like IWM. Really difficult to prepare for those things. You really can. It's just the way that you position your market or position your account, which I talk a lot about in terms of keeping money readily available so that you can access it when you need it, which in this example, you will see I needed it. So fast forward to the 23rd of March, and I didn't do anything with these 125s. I'm just kind of sitting and waiting, but I did offer more. I offered a 15 lot at the 17 April 97 puts. The reason why I offered this exposure is because of the drop, right? You can see that my strike here is 125. And this is really going to be used as an anchor to reduce my basis if I get caught at this 125. So if we take a look real quick on the calendar, 23rd of March, that is pretty much when we were hanging at the lows. And again, not knowing how this thing was going to play out originally, most bear markets take like 280 plus days to recover. So I was kind of gearing up to scale into this thing in a pretty meaningful way to ride it out pretty much however long I needed to. essentially resigning the fact that these 125s at that point are stuck. I chose not to try to roll them. They were too deep in the money. It was too fast. When you see something drop from closed at 125 and then it opened at 116, that's a really, really tough trade to even try to roll without some sort of move in your direction. And you can see there was no move in my direction, essentially. So because of that, I offered a slightly larger position out here to serve as an anchor. In case we started seeing continued market decline, it would give me something to offset really those 125s, which were going to be caught up pretty high and not much I could do with them. So 27 March, you can see that I was assigned on trade 1. And I forgot to go through the nomenclature. So you could see I'm pretty much keeping the trades tied to each other. So T1A is just trade 1A, and then T1A is still trade 1A. So you can see that's how I'm tying them together. So in this instance, trade 1B, those 125s, I took assignment. So at this point, I'm long 500 shares at 125. Obviously, I keep that credit. I didn't pay anything out of pocket, so I'll collect that money. And I also sold to open an additional 10 lot on 1 May for 1 May at the 109 put. And I collected $7.18. So what's going on right now is I've established a second working position. These 97s are still going to serve as my anchor in case the market continues to decline. I have something to work with for those 125s to reduce my basis to something manageable. And then this is kind of a working position. This is something that I may adjust if I need to, I may not. Kind of depends on how the rest of the market goes and really how it fits in with the rest of my portfolio, which again, I've kind of isolated from this example and just pulled this piece out. So at this point, we have a total unrealized / realized P&L of 17,270. And the reason why I'm bucketing the unrealized and realized together is just so that you can see when money is coming in, when money is coming out, regardless if a trade is open or not. But I did make a specific point to call out the overall capital tied up in that position. I'm not counting that in this P&L whatsoever, simply because it's long stock, so it's an asset. I could hold that into perpetuity. That's just what I paid out the door. So I'm kind of keeping that in mind. That is 100% part of my calculation that you'll see at the end, but that's just why it's not in this tally on this side. So let's just take a quick look at 27 March. And that's right here. So I essentially allowed assignment over that weekend, I think, if I remember quick. Yeah. So the 27 March, this really was going to be assigned. So this, I just realized, this should actually be 30 March. This should be the Monday following. This is just when this position was assigned, which is why I started that there. But on that Monday is when I, kind of considered the settlement assigned, and really there's more importantly the second position that I added on. So to be very clear, these 27 March 125s, they were assigned over the weekend. So really 28 March is when it would have settled. And then this right here should read the 30th of March, which is the Monday, and it's just because I have this other trade tacked on. Realistically, this assignment happened on the 28th. So like I said, I offered those additional 10. So let's just pop back out to the 30th very quickly. So this is when I offered those additional positions, and this is when this is the 30th and then the 31st, and this is over this weekend is when I was assigned. So on the 30th is when I offered those trades. This great thing should be one over. And then what you'll see is I waited a day, and then I decided to start adding some started adding some short calls on the long stock. So on the 31st, day after, I sold to open 2 of the 125 calls for $2.19. Those were expiring in 1 May. Now, what's going on here is I want to collect something for this long stock, but because of where everything is priced, I can't collect that much money. So I don't want to cover up all of those shares. I still have room to grow, and I still have the expectation of taking in more shares at some point. So I'm not worried about offloading these shares as soon as humanly possible. Again, I'm kind of gearing up for a longer haul here. So then let's go forward to 14 April. You can see there's a pretty big gap there. And it's just because when the markets are like this, especially since I'm isolating this position, I'm not trying to rapidly trade in and out. You got to let these things do what they're going to do. And that's really what happened in this instance. So those 97 puts, I actually closed those out for 34 cents. And that was just to take some risk off the table. It made the move that I wanted. I collected most of the premium out of that trade. And just generally with the uncertainty in the market, I didn't want to continue holding it, because if you take a look on 14 April, we're seeing just this really significant rebound out of the market. And I am one of those people that I just did not trust it. What was happening didn't make sense to me. So I was seeing this pretty significant rally from, $96. We hit a high of 125. And this is like during the heat of COVID. So didn't feel confident, decided to take that trade down for some profit. And then the other thing that you'll notice is I also offered 2 more short calls at the 128 expiring 15 May, collecting $4.13. You can see the math over there. And realistically, this is just because we're starting to get close to the strike. And I was like, okay, well, I can move my strike even a little further above my basis and collect a few more dollars. So right now I'm just keeping 100 shares open. And that's really just because I am waiting to see what the market does. Because at this point, it's doing a lot of things that don't make a lot of sense to me. So next up, we have on the 24th of April, so 10 days later, I took down those 109 puts, and I also took down those 125 calls. So what happened here is I decided to, again, take this risk down. Now, in reality, I was trading, offering additional lots back out to the market. But again, I'm kind of isolating a piece of this trade. So I make that caveat here because I know at this point, after I took these 109s down, I offered a bunch of other stuff. But I'm just kind of considering that a separate trade for this example. And then I took down the 125s because if you take a look on 24 April, the market kind of stabilized here. So I was thinking, shit, maybe the market might rally and I don't need to let my stock go at my basis. So that's exactly why I just chose to take those calls in and kind of see what the market chooses to do at that point. So as of right now, I'm long 500 shares and I have these 2 short calls out. So then we go to 27 April and I decide to offer the rest of my short calls to essentially unwind this position at the 128. There's enough capital gains to be had here and pretty good premium in the trade. So I sold 3 of the 128 calls to kind of even that out. 15 May, same expiration, and I collected $4.16. So on the 18th of May, so you could see there's another pretty big break, literally just waiting essentially, and these expired out of the money. So kept all the premium on those 128 calls, and then I offered 5 at the 130 handle. So this was actually slightly in the money when I chose to put those out. And the reason for that is because I wanted to unwind the risk. Did not trust this trade whatsoever. Long 500 shares, great exit opportunity. So on the 18th, I offered it for 22nd, that Friday. And that was just because I wanted to essentially be able to get out of that trade for a fair profit. And that's pretty much where it ended. So on the 23rd of May, that's that Saturday, expired in the money. So it means I got called away on those 500 shares. This was the P&L on the stock. So I did not include the premiums here since I already calculated those. So this is just what I made on the stock on top of, the options trade. So this is what it came out to, 23,351 over the course of a 75 days in this series of trades. So my max utilization during this was 317,000. And this comes out to a 7.4% return on capital, which is about 36% annualized return. So this is just a very brief example of the Covered Strangle. I have, versions of these that go on literally for over a year, but I was hoping that I can kind of give you a good synopsis of what this thing looks like in different market conditions and why sometimes taking assignment just makes so much sense. Just wait. And it worked out beautifully in this case because the market rally was so rapid. But even if this took 200-300 days, this is still a really solid return on something that moved against me, essentially $40 from the high when I entered the trade to the low when I exited. So hope this was helpful. If anybody has any questions, as always, drop me a line in the Google form below. Let me know, and I will talk to you all later.